Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our good friend Lawrence Lepard. He is an investment manager, sound money advocate, and a gold stock fund manager. Welcome back, sir.
Thanks, guys. Really nice to be with you. Always enjoy catching up with you, Jim and Ivan.
Yeah, it's an absolute pleasure having you on, Lawrence. So, Lawrence, we're in the middle of a global crisis, energy crisis, and an ongoing war, and the US dominance is being challenged worldwide. How dire is the situation across the world going into 2023?
It's quite dire, sadly enough. I mean, that's not something I relish in saying, although it's not terribly surprising. I mean, certainly at a financial level, it's dire, and we can dive into that more. Obviously what's going on in Europe, the energy problems, the destruction of the Nord 2 pipeline, the Russians, rattling their sabers about nuclear weapons. I mean, a lot of bad shit going down, and not a lot of good news on the horizon. It strikes me that we've got tough times coming here and some real problems. Um, you know, so, but the part I focus on, I don't really focus so much on the Russians and the geopolitics and the nuclear war, all of which could have an enormous impact. I'm focused on the monetary piece of it all. And as I was saying to you guys in the pre-show, what happened with the Bank of England was just this is an earthquake, right? I mean, this is a really, really big deal. It's what do they say? One shot, who knows, two is possible, three is enemy action. Well, the first shot was Japan, right? A
Mhm.
couple of weeks ago, maybe a month ago, that Japan came out with full-blown yield curve control because they were losing the peg on the 10-year Japanese bond, and so they had to go in a couple of times to keep it down to 25, and then they had to intervene in their foreign currency market. And by the way, that's why they've been selling treasuries and why treasury rates have been going up so relentlessly. But that was step one. Step two was when the Europeans had an emergency ECB meeting to address the fact that the Italian bonds were blowing out. And if you look at the Italian CDS right now, as my friend James Lavish so accurately portrays and shows these schedules all the time, Italy, the market's saying Italy is going to go BK. Yeah, what we're watching here is basically this is showing the price of the CDS spreads on all of these various countries, and the CDS is the credit default swap on the currency and the country failing. And as you can see, Italy is at the top of the list in terms of the size of the spread and growing rapidly. And look at how on all of these, I'm not sure what the period of that average is. I think it might be three-month average.
Mhm.
But look at the blue dots. I mean, we're way above average on all these. And what this tells you, the quick summary on this chart is that this is it's showing you the stress in the system, and people are beginning to worry about countries not being able to make their obligation or going BK, and it's a
Yeah.
big
Wow.
deal. But as we were saying, the three strikes and you're out. So the third strike, and I think you guys have some charts on these. You might want to bring up the chart of the gilt, the 10-year UK gilt. The third thing that happened, and this to me was really cataclysmic. England had to do a full reversal of their policies
Right.
and come in with enormous stimulus and buying their own bonds, buying their own currencies, probably selling U.S. securities to do so as a result of the collapse in the UK gilt. And this is because what they did was they said that they were going to cap everybody's electrical bills. The new Prime Minister Truss came in and said this, which was a big deal and understandable because the electrical bills are up between 200% and 500% for a lot of people. However, the point there being, where are they going to get the money to do it? And the answer is they're gonna print it.
Well, they're
And
going to
then on
print
top,
energy. They're going to print energy. Isn't that how
they're
you
going
do
to
it?
print energy, right? And on top of that, another person in their thing, I'm forgetting his name now, but the finance minister basically came out and said they're going to do a tax cut. So
Hmm.
basically, the UK is really, really messing up their fiscal situation, and as a result, UK bonds felt it. And then take a look. I think you also have the UK, the Great British Pound. The pound had a similar trail off. I mean, for a major currency, I mean, look at this. The pound in May of 21, was a
Hmm.
buck 40, and now it's just above parity. For a major currency to lose that much value in that span of time, I mean, that's
Right.
shocking and unprecedented. And one of the things that a lot of people tend to forget is we've got $600 trillion. We've got $400 trillion of financial assets in the world. We have arguably at least 600 trillion of derivatives. Some people say more if you count notional versus netted out, but whatever. We've got a lot of derivatives. A lot of those derivatives they're built around FX, currencies, and they're built around interest rates. So when you get this kind of moves, things blow up. And the reason that the BOE had to do what they did was that their pension schemes, I mean, there were some headlines, I'm sure you guys saw them. There were some headlines that basically said, this was Lehman-like. We were days away from failure.
Yeah.
And so, I mean, this was kind of echoes of 2008. I mean, arguably even echoes of 1998, because it's broader than just the housing market in the US. I mean, we're seeing this around the world, the strong dollar. You might want to put up a chart of the dollar index. I mean, the strong dollar is just destroying. It's like a wrecking ball.
Well,
So,
here's the DXY, the dollar index.
Right.
So it's up to 112 today, but it was 114 a few days ago.
And that was right when the BOE intervened. And it's kind of ironic that the BOE would intervene and say they're going to print more money and the dollar would actually go down. But a lot of complicated things going on here. I mean, a lot of people had the same trade on, and they decided to move out of that trade very quickly. And I think that's why the dollar came down. I mean,
I saw speculation on Twitter that we might see the first coordinated central bank moves to, stop the rise of the dollar by all the central banks together for the first time since the 1980s. They used to really do this a lot back in the 80s, but they really haven't. I mean, one currency going up so much, so quickly, that blows up a lot of trade contracts, a lot of trade agreement, a lot of trade relationships. It just no longer makes sense to import or export for a lot of different products to a lot of different countries, right?
That's right.
It hurts the United States dramatically over time. I mean, our exports become dramatically non-competitive the stronger the more that this happens.
That's correct. That's correct. Anybody who has dollar-based debt has to pay more money to service it.
Yeah.
Put up the US 10-year. I mean, it was doing the same thing. There you go. And it reversed at the same time. But look at that. I mean, the US 10-year in July of this year was at the 2.6 level, and it just made a beeline for 4.0. And that's, of course, because inflation remains hot. What they're doing to calm down inflation is not going to solve the supply problem. And, people holding the 10-year are going to say, hey, get me out of here. I'm getting a negative yield.
Well, forget about July. I mean, not that long ago. I mean, we're talking March or I mean, this is only a year ago. It was at
that's not long.
1%.
Yeah, this is the fastest increase in interest rates I think ever recorded. As somebody pointed out on Twitter. I'm not sure if that's correct, but it seems very close to being correct. And the other reason this is going up so much is the thing that you have to consider is that that we have a net negative foreign investment position. In other words, a lot of foreigners own $7.5 trillion worth of our bonds. Okay, and Luke Groman does a great job of pointing this out. And if they want to defend their currencies or they need to service their dollar-based debts, they're going to sell those bonds to get cash to do so. And that's what's pushed these rates to where they are. And then, so what we're really kind of leading into here at a big picture level is what others on the web have so accurately described. It's kind of a death doom loop. I mean, there's Sven Hendricks recently just pointed out how fast the U.S. interest rates are going up. That's in his thread. You can find it. And the fact of the matter is, as interest rates go up, the cost of servicing our $30 trillion worth of debt goes up very, very quickly. I mean, look at how that's trending north. And what this is telling us is that the federal government's interest expenses are rapidly moving towards $1 trillion a year, when as recently as a few years ago they were closer to 300-400 billion. And this is going to blow out the deficits, combined with the fact that they don't have the tax income that they got. They had an exceptional year in calendar 2021 because we had a bull market and a lot of people paid capital gains taxes. The tax income that they received in April of 2022 was almost $600 billion above trend line. And that's a huge number. And so they're showing they're going to have a deficit this year between 1 and 1.5. Let's call it 1.2. Add 600, it's 1.8. Add another 300 or 400 for this interest going up, and that's into the twos. And then you got to reset Social Security. It's going to get, for the first time in a long time, Social Security is going to get a 10% bump this year, right? So there's $1.5 trillion or 6 of Social Security payments. Those are going to go up by 1.6. So the U.S. is back into, very quickly, the world's going to realize the U.S. is going to be back into $2.5, $3 trillion deficits. That's not going to make bondholders happy, and these interest rates are going to just keep going up. So the outcome of that is going to be that they're going to be forced into yield curve control. And yield curve control is just another fancy way of printing money. You know, they can't have higher interest rates. So what do? They go into the marketplace and they buy their own bonds. They create a bid for them to hold the price down. The problem is that to create that bid, they have to, you know, create reserves, or in a sense, real money that they don't have. And so, you know, they're printing, they're monetizing the debt. They're printing their money. I mean, this is all very third world, you know, banana republic kind of.
Well, I mean, it's not though, because that's essentially what Japan has done, and why Japan has reached the end of that potential. Japan can't. They've reached the limits of how effective that can be.
Well, that's right.
Once you own half the bond market, once the central bank owns half its own bond market, I mean, they own it all, right?
Pretty much. And I mean, and Japan's a better case than us because they have, you know, they run a trade surplus and they run an investment surplus, and their people are savers. So, you know, the bottom line here, guys, as you know, we all know, is that, you know, the currencies are toast. I mean, it hasn't been widely recognized yet, but you know, these bonds are worthless and these currencies are worthless at the end of the day, or they will become increasingly more worthless over time. And the only difficult thing to do is to manage the, you know, the swings, because there are a lot of swings.
I saw a study on that I think it was Tavi Costa, that $6 or $7 trillion of our debt matures every year.
Yes.
So that roughly all that debt that was issued in previous years at 1.5%, it's all, you know, 6 or 7 trillion is now rolling over every year that has to get refinanced at 4%. So that's what's leading to, I mean, if we stayed at 4% rates for 3 or 4 years, then probably the bulk of our debt is now no longer at 1.5%. It's now at 4.5%.
That's correct. And as you'll recall, Steve Mnuchin tried to sell 30, 20-year bonds, you know, back when he was Treasury Secretary, and he found out there just wasn't a lot of appetite for them, and they were more expensive. So they've really listed toward all the short-term stuff. And I think the average debt maturity is somewhere between 2.5 and 3 years right now. So our debt rolls over constantly, and at higher rates, it becomes an enormous problem. I mean, it's like being a household where, you know, you've got these credit card bills bearing down on you, and you don't make enough income to service them, and they keep growing, and you're opening up new credit cards to pay the interest on the old ones. And, you know,
it's just a spiral.
It's a spiral. You can't get out of it. You just can't get out of it. And I mean, the government says they can get out of it because they say, well, we'll print the money, but that's only a short-term palliative. I mean, that's what the Weimar Republic did too. And
well, that was the famous Greenspan line. We can guarantee payment on the debt. We just can't guarantee buying power of the currency that's used.
That's exactly right. And the currency is going to be sacrificed. Now, it's very confusing though, because everyone says, well, why is the dollar so strong? Well, the dollar is strong because it is the reserve currency. Everyone needs it. A lot of debt is dollar denominated. And, you know, credit to Brent Johnson for his dollar milkshake theory and having that piece of it completely right and being vindicated. But, you know, the fact of the matter is that the dollar will fail too eventually. It's just these others are in more trouble. They're going to fail earlier.
So, you know, how does this all play back into gold? You know, so we all believe, you know, if you're in this trade for gold and other commodities, the thought is, all right, eventually this all fails, and eventually the Fed has to come back in for yield curve control, or eventually the Fed has to at least stop raising rates, at least pause, because they just can't take the pain anymore economically. So at some point this has to happen, and that's what a lot of gold and precious metals and commodity investors are waiting for. But do you get a sense, are we close to it, or is that some time off in 2023 before that pain point's reached?
We're in the real short strokes. In my opinion, we're very close to it, and I'm not even sure we're close to the Fed capitulating yet. I think they're so stupid they're going to keep pushing it until something breaks. And of course, things are breaking, but I think they're going to need an accumulated evidence. I mean, look, if they change their policy right now with what's broken now, they would lose all credibility. Okay, they just have not. They have not. You know. So what they need is another crisis, and they're probably engineering it and trying to figure out what their response is going to be. And of course, at that point, they will pivot, you know, and because they have to. I mean, the choice is to watch every market go to zero, a la 1929. So it's coming. We don't know when. I personally think, and there are varying views on this. I personally think we just put in a bottom in gold and silver that won't be broken or tested. I think
the low 1600s was it? The low
1610. I think that was it. Yeah. Now, but there are a lot of smart people that I respect who think, no, you got one more leg down, and we could. I mean, we definitely could. But in terms of time, we're getting very close, and the reason that we're getting very close is that we're at that stage of the game where things are breaking, and they're breaking more severely, more, you know, and they compound upon each other, you know. Right. And so you know, it's like Preston Fish says it so well. It's like the contractions are getting closer, right? We're about to have a baby here. I mean, this thing's
going to be a big one. We got twins.
Yeah, it's going to be a really big one. It's going to make 2008 look like a, you know, kids play. It's going to make 1998 look like kids play. It's going to be a really big one. And, you know, I mean, eventually, if you go into serious yield curve control, you know, the entire bond market might look at the Fed and say, sold to you, you know, and so you could see a Fed balance sheet going from 9 trillion to, you know, 20 trillion, 25, 30 trillion. And at that point in time, you know, as you guys know what Gresham's law is, we all do. I mean, and we all know what triggers hyperinflation. What triggers hyperinflation is when everyone realizes they cannot stop, and they will not stop. When the entire population comes to that view, then Gresham's law kicks in, which is you want to save in money that you know cannot be debased. And that's where our stuff's just going to go bananas. I mean, we're going to, you know, my view is when gold takes out 2000, it'll make a beeline towards 3000. And when silver takes out 25, it'll be a beeline towards 50.
So, Larry, you know, we all agree silver and gold are probably going to go eventually. But what's the, you know, you're a money manager. You specialize in picking these stocks for how to best take advantage of this situation.
Right.
So what's your strategy out there? I'm sure you diversify. You don't bet it all on one name, right?
Right. Exactly. I mean, I think, I don't know how familiar a lot of your listeners are very familiar with this, but I always like to repeat to anyone who's not familiar with investing in this category that these things are all risky, right? And every now and then, even a good company can blow up. So it's critical that you don't buy one gold or silver stock and hope that that's the one that makes it big time. What I try to do, Jim and Ivan, is I look at all the stocks out there and I try and narrow it down to what I consider the best risk reward based on management team, deposit, production, etc. And I'm looking for situations that I believe can become 5 to 10 baggers, you know, with higher metals prices in the next few years. And I know that if I pick 10 of those, you know, maybe 1 or 2 won't work, but the other 8, you know, will kind of work. Some will be 2 or 3 baggers and some will be 20 baggers. So if you blend all that together, you know, the ones that work you know, they pay you for the mistakes. The other thing I tend to trend toward, unlike some other funds that are well known, is I tend to go for the producers. I like the producers that are growing because they have positive cash flow. If you're a drill store, you need to continually raise money. And in a friendly climate, you can raise the money. But in a tough climate like we've got right now, it's hard to raise money. So I think the real sweet spot is a junior producer that's got positive cash flow, but they have the ability to grow their production through, you know, increasing the capacity of their existing operation or adding new mines as they go forward. So to me, that's the best sweet spot in looking for upside with less, you know, controlled risk on the downside.
So what are some names that you really like right now that sort of fit that model?
Yeah, well, I'm a big silver bull. I think silver's gonna, and it's funny, I'm on Wall Street Silver, right? We just like silver.
That's why we invited you.
That's okay, right? I think silver's gonna go further and faster than gold. I think silver's got a dual use case. I mean, it's a monetary metal, but also we're just using so much of it and we don't have enough of it in stockpile. So I'm gonna give you 2 silver stocks and then one gold stock. My 2 favorite silver stocks right now, or 2 of the many favorites, but the ones we just discussed talking about, are Silver X, which is a growing producer, you know, down in South America. I love the CEO here. I love what they're doing. I love the month-on-month growth, and I think this could become a very meaningful company. And it's a peanut right now. I mean, the market cap is very modest.
The market cap on this one's only $30 million.
Right.
And they're producing 200,000 ounces per month. So 2.4 million ounces.
Right.
And so their cost of production is like below $10 an ounce, something like that.
Right. I think it's a tad higher, but they've got a good margin on each ounce produced. That's correct. And more importantly, they're not going to stop at 200,000 ounces a month. I mean, going to grow this thing. So, you know, it just is, it's undiscovered. I mean, people just have not focused on this company and the stock, and that's why it's so cheap. I just love it.
I'm also an investor in this one. I really like it a lot. So I mean, I agree with you. But as with anything, I don't think anyone should go all in on any of these. Nibble away at this. If nibble away at this and take a, you know, if $1,000 bucks, $2,000.
These small ones are volatile. There's no doubt about that. But
this is a good entry. This is a good entry point on something like
a very good entry point right now. I mean, this has the ability to multiply in value, in my opinion. Another one that on the size spectrum is a little different. It's much bigger, but it's equally interesting in my mind is Aya. They're over in Morocco, as you know, and this deposit is just enormous and world class, and they're just getting going. I mean, they're at a very small run rate right now because they've just kind of gotten started. But I think the size of this deposit would imply that they could ramp this to 10, 15 million ounces of silver produced a year, not too far out, probably 2 to 3 years out, which, you know, that kind of valuation, that kind of production will lead to a multi-billion-dollar valuation. Now, this one's not as cheap as Silver X, but there's less risk because, you know, they've got the mill completely built, or they're in the process of building up the expansion, but they've got the base mill built. And, you know, it's a higher market cap, but I can see this being a, you know, $2, $3, $4 billion company, which is multiples of today's value. The other thing is, this is all based on the one big first deposit, and they've got an enormous land package. And if you look at that, they've flown the rest of the land package. And what you can see is that there might be 3 or 4 other deposits around on it that look very similar to the Zagounder one. And so there we go. Aya
is really known for their drill results at Zagounder.
Right.
Just insanely thick, high-grade silver. They just announced their first drilling results for this other project in Morocco, and it was just as good.
Exactly.
In a totally different area, a totally virgin new area.
Right. So if they have 2 of these, I mean, it's a good bet just based on the first one. And you were right. I mean, they were getting decent size intercepts of, you know, between 2 and 12 kilos per ton, which is just off the charts. So, you know, if the second deposit turns out to be like the first one, and they actually have a couple of other targets that they think are just as good, this is going to be a very major silver mining company for a long number of years. And that's really how value gets built. When you have super high grades and you have super long mine lives, you know, it takes time to unearth it, but eventually, you know, you grow to be billions and billions of dollars of market cap. So
they're producing about 1.8 million ounces this year, but they've already got the money in the bank to expand this to something like 8 or 9 million ounces. So I think in 2024, all of that new infrastructure comes online. And the production dramatically goes up next, you know, in early 2024, which
I've known the guy who runs this for 20 years. His name is Benoit Lassalle, and he built Semifo, and he's just an outstanding human being. A very good mine manager. So I have a lot of confidence in this one as well. I really like it.
So you're also a gold bug, Larry. We all know that. So do you have a gold one that you really want to highlight?
Yeah, just to balance things out, I've got a favorite growing gold miner, small growing gold miner called Galantas Gold in Northern Ireland.
Home of the leprechauns. Yes.
Yeah, home of the leprechauns. This is a great story, Jim. I mean, it's an operating mine. They've started production. They are producing gold at a very small level. They're just getting started. But this mine and this deposit look very similar to a deposit that's also nearby in Northern Ireland, same strike, called Dalradian, which was purchased and taken private for a large sum and is now proven out to have kind of 7 million plus ounces. This is high-grade gold in quartz underground, so it doesn't really disturb the environment. They've got it fully permitted. They're operating, so there are no issues in terms of Dalradians run into permit problems. They've had a lot of green and local opposition to building a mine, but these guys have got the mine built. It was a historical mine, and they just kind of revamped it and got it going again. And you know, it's quite small right now. I mean, it's maybe 20,000 ounces that they're going to produce this year, but the deposit is open. It's, you know, on scale, on strike, and depth. I mean, I have no doubt there's a lot of gold here. And what I like about this company is they're not going to dilute us. They're not going to go raise a ton of money. to build this mine. They built the mine and they'll have cash flow, and that cash flow will allow them to expand the mine. I mean, they may take on a little bit of debt, they may do a little bit of equity, but it's not one of the greatest risks when you're talking about any company that's growing is what's the CapEx? How much do they have to spend, and where are they going to get the funds? And are they going to dilute the hell out of you when they raise the funds to build, to grow it? And in this particular case, this is one of the ones, there've been others that have done this. I call this kind of the bootstrap method, right? Where they get started, they mine a small amount. If they do 20,000 ounces at their cost, that'll be $20 million of capital that they'll get in. They'll take that 20 million, they'll increase their capacity, and next year they'll do 40,000 ounces, and then 60 and 80. And, before we know it, they'll be at 200,000 ounces, and a 200,000 ounce producer is worth, $700 million. And what's the Galantis market cap right now, Jimmy? Is that
like 30 or $40 million is all it's at.
Yeah, I'm looking at Canadian, it's 49. Yeah, $49 million today. So I think there's a lot of upside here. You've also got some really smart people in here investing in it. Ross Beatty owns a piece of this thing. I think Tukey Angus.
Michael Gentili owns it also.
Yeah, Michael Gentili owns a piece of this thing. Tukey Angus owns a piece of this thing. So, and I met the CEO. I just met him out at Denver Beaver Creek, and he's as solid as can be. So I'm very excited about where this thing can go.
Yeah. I'm also an investor in this one, so I agree with you 100%. So Larry, jam through like a couple more names that would be
so
other people should just look at, not detail or anything, but
we started off with you got to be diversified here. So let me just give you kind of my top 10 names and go look at these on your own. I love Equinox, I love Osisko Mining, I love Guanajuato Silver, I love Aris, which is the merger of GCM and Aris. I love I-80. I love Silvercorp. I love Sabina. I love Pan American. I love Hecla. And then the two dark horses, I'm on the board of each of these companies. They're small and they have risk, but they could easily be 10 baggers, are Lavras Gold and Rise Gold.
All right.
And I'm a director of each one.
All right. So full disclosure, you're talking your book. We get it.
I'm talking my book, but you asked for it. And all I can promise you is I've been in this game. I've had some good numbers, and these are my best ideas.
Well, thank you very much, Larry. We appreciate it, and we will definitely talk to you again in the future.
Look forward to it, as always, Jim. Take care.
Bye-bye.